Received a copy of those minutes. Are there any comments to the minutes?
Chair, sorry. Chair, I know I'm not on the committee, but I did attend, along with my colleague Trevor, all at the meeting as members of the pension board, but we're not listed on the minutes as attending, but we did attend.
What do we normally do there, Joe, if there are people who are in attendance but not part of the committee? We will update it, Michael, and I think going forwards we'll make a note of everyone who's in attendance as well as is actually sitting on the committee. Make it we will need to draw a differential between them, though. Yeah. Thank you, Michael. Claire.
Is this working now? There was a question by Councillor Quigley that said that it was with Chief Executive for review in the minutes. Have we had that answer to his question about the fund's investment in fossil fuels?
Through you, Chair, we haven't published. This was in response to the press inquiry about fossil fuels and investments. I provided the response to the Chief Executive, and the Chief Executive decided not to take it any further, so it hasn't gone anywhere in terms of publication of where we are in terms of fossil fuels. There is a public question on fossil fuel investments which is coming up shortly on the agenda, for which there's a written response been prepared, so that may cover it, or I can share the information, but it's out of date from where it was before, so I can update the information on fossil fuels if that's okay.
Thank you. Yes, an update on that one. We'll see how the question.
I think the updated question we've got in terms of the public question will probably address it. I suspect this is going to be an ongoing, sort of like a standing question on the agenda, though. Now, almost every meeting, it's going to keep coming up. But we do have a public question, and I'll read that response out, which is quite comprehensive, in a minute. So, if there are no further questions on the minutes, would somebody like to propose them? All right. Councillor Andre, and somebody to second it. Right, Councillor Richardson. All those in favour, please signify in the usual manner. Anyone against? Right, passed. Declarations of interest, then, is the next point on the agenda, item 2. Are there any declarations of interest? Councillor Brading.
Just to point out that my wife is part of the council's pension scheme.
Good point.
That can be noted, but it doesn't need to be a declarable interest any further. We'll note that, but we don't need to declare it any further.
Not at subsequent meetings?
No.
No. All right. Thank you for that. Sorry, Steve was scratching his head there, but I had a question. Item 3 on the agenda then is the public question time. We have one written question, and I will read it out because there's only one. The written question comes from Sylvia May of Totland. Many of us will know Sylvia very well from her work in the renewables and similar fields. The question is, over the past 5 years, the Isle of Wight Council Pension Scheme invested more than 7% of its funds in fossil fuels, directly into fossil fuel companies and indirectly through banks and organisations supporting the industry. During the same period, the Isle of Wight Council formally recognised the climate emergency, encouraged increasing biodiversity and rewilding of our environment, rejected the government's demand for unsustainable housing development, produced an island plan alongside an environment and climate strategy to reduce habitat loss and cut local emissions. Last October, the Planning Committee unanimously rejected plans for oil production on the island and recently initiated an independent biosphere steering group to develop a holistic approach towards achieving economic and environmental balance through a net zero agenda. Will the committee commit to build on these important achievements by divesting all pension funds from fossil fuels into more sustainable environmental and social portfolios and green energy development? The response is, the pension fund is a long-term investor and the investment should be able to generate sustainable returns to pay pensions for scheme members. Environmental, social and governance issues can have a material impact on the long-term performance of its investments. The pension fund continues to develop its investment beliefs in respect of ESG factors and its responsible investment activities, and is working together with other funds in the access pool to develop its approach to stewardship and engagement matters. In implementing the investment strategy following the 2019 triennial valuation, the fund has reduced its overall allocation to actively managed equity funds and has added investment into private debt, infrastructure, and a passively managed climate-aware global equity fund. As at the 31st of December 2021, the total value of the fund's investments was £765.5 million, all held within pooled funds. Approximately 16.7 million, 2.2%, of investments were in companies with a significant involvement in fossil fuels. In addition, approximately 19.4 million, 2.5%, had exposure to renewable energies. When identifying the managers for the new asset classes, the selection process considered how the managers take into account ESG factors when developing their investment portfolio and their approach to engagement with the companies in which they were invested. At each committee meeting, one of our fund's investment managers is invited to present their portfolio's performance and to report on their reasons for holding investments in fossil fuel related companies. The fund believes that engagement with fossil fuel companies in order to determine their approach to a just transition to a greener economy is preferable than to immediate divestment from those companies. However, selling an asset remains an option when it comes to an unaddressed ESG concern in the investments made by our managers. There we have it. So we're heading in the right direction. I think that's quite positive news, and hopefully Sylvia will be more than satisfied with that, that update. Hello, Vanessa. Right. Are there any other public questions? We have nobody in the gallery. Nothing else received. Right. So moving on. Ah, Steve.
Sorry, just to follow up, could we get a copy of that response? Because I think that'd be helpful for us to understand where we are.
So I know it's not common with every committee you have at the council, but I do find it rather odd sometimes that we have written questions and written answers which are then not included in the minutes. And I wonder if we could do that going forward, at least for this committee. I can't speak for other chairmen, but I think it would help, unless anybody's got any objection to that. No? Good. Thank you, Steve. So at this point, we do have some people waiting to make presentations to us and trying to be economical with their time. What I'm proposing to do is to now move on to items 8 and 9 on the agenda and then come back to the updates so that the people who want to address this morning can do that first off, and the people who are waiting outside the door can take part in the meeting at the earliest opportunity. So I think at this item, we jump forward to item 8 and deal with the investment performance of the fund, which starts at page 25 in your pack.
So if I start with yeah, it's just over.
Are they on?
So if I just start with a very quick overview of the investment assets, the value, as mentioned in the response to the public question, is £765.5 million, which is the highest that the fund has achieved to date. Page 25 of your pack shows a breakdown of the investments by the different asset classes that we have, and you'll note that we are now invested in all of the asset classes that we agreed as part of our investment strategy from the 2019 valuation. That activity will be reported on later in the agenda, but I'll hand over to David, who's on the screen from Hyman's, to give us an overview of the performance of the fund managers. Thanks, David.
David, if I may, just before you speak, just to aid you in your update to us, there might be a few questions that you could perhaps address or even amplify when you do the update, if anybody has any particular issues that they'd like David to include. Oh, right. So just, David, for myself, one of the things I would like to do is when we're talking about the funds, a number of them have been below the target relative to benchmark. That was one issue. And the second issue I really wanted to cover was the issue of the investments we have in bonds at the moment. It's been an area just of some concern, the performance of the bond markets, and with a relative high rate of inflation, perhaps that's an issue you might want to address at some point. And we'll hand over to you now. Thank you.
Okay, thank you, Chair. Just one thing to note, my colleague Emma sends her apologies. Some of you have seen Emma at previous meetings, but she's unable to speak today due to a chest infection, so she passes on her regards. I suppose the first thing on kind of page 28 and 29 is just to give a bit of a market background. So this report covers the period up to the end of December. Things have moved on a little bit since then, but over that quarter, we did see, I suppose, the spectre of continued high inflation, with forecasts continually rising and seeing high realised inflation. So that was starting to present a squeeze on household incomes, and the resulting policy action in terms of expectations of policy tightening and interest rate rises as we go into this year. So that started to impact growth expectations. There was some more positive news in terms of the COVID-19 and some of the infection rates starting to fall, and hopefully seeing a pickup in growth and supply chain issues starting to be addressed. But certainly growth forecasts are a bit weaker than they were in going into 2021. In terms of the markets, equity markets did have a good period overall in Q4, but we saw a bit of a turnaround as we moved into January. In fact, January has been one of the worst months that we've seen in equity markets since the onset of the pandemic in March 2020. But certainly Q4 at least was a good period for the fund and for your managers. We've seen also a little bit of a switch in terms of the types of stocks which have done well, with some more growth-focused stocks where they had kind of high valuations and rely on kind of discounted earnings starting to underperform due to the expectations of higher interest rates, while some of the oil and gas prices or oil and gas stocks have actually been doing well given the higher yields, and financial stocks have also benefited in this environment. Touching on inflation, we've got the chart on the bottom left of page 28. It shows what's happened with CPI inflation, and clearly there's a bit of uncertainty in terms of supply chain issues and how persistent the inflationary position will be. Clearly, there's also geopolitical tensions at the moment, which could impact things like oil and gas prices. So still a risk that inflation persists at some of these high levels, although there's still a kind of range of base effects that should wind through and hopefully bring that back down as we get towards the end of this year. In terms of interest rate expectations, I say we've seen banks start to act in terms of announcing rate hikes through this year, and so that's starting to impact on markets and particular bond yields. So just specifically on that, on the following page, page 29, you'll see gilt yields up to the end of December, but what we've seen since then is rises, and particularly kind of nominal yields, reflecting those expectations of higher interest rates. And then on the right-hand side, we've got credit spreads, so the additional spread you can get from investing in corporate bonds. That has also kind of moved out as we've moved into the current quarter, with more concerns about potential defaults or kind of higher risk within those credit markets. So overall, in terms of markets, Q4 was a kind of strong period for the fund, but we have seen a bit of a turnaround as we've moved into Q1. In terms of the asset allocations and positioning, kind of moving a couple of pages onto page 31, as Joe has outlined, the fund value at the end of the quarter was as high as it's ever been, kind of grew by 30 million over the quarter. In terms of the asset allocation positioning, some key changes were, firstly, they move or restructure within the equity mandates to fund the new UBS Climate Aware Equity Fund in December. So that's now in place and at target. Some of the other newer allocations, the Goldman Sachs GSAM private debt allocation is now starting to draw down money quite well, and in fact has already started distributing income back to the fund, which is part of the aim of that strategy, is to provide that steady income stream and also help with kind of net cash flow requirements over time. The infrastructure mandate with Partners Group has been a little bit slower to fund, but is starting to build up and should continue to build up over the course of this year. In terms of relative performance, something you touched on, Chair. So in terms of the last 3 months, we've seen positive returns from Newton over the last 3 months, 12 months, and 3 years. Majedi a little bit behind, still okay relative to their benchmark over the 12 months, but actually behind their kind of active performance target, where they're expected to outperform that. Explicitly on Majedi, I know they'll be coming in to present to you. But to provide some additional detail, we have fairly recently downgraded them in terms of our manager ratings. We previously had them as a preferred manager and have moved them down to suitable. In terms of the rationale for that, the team has experienced a reasonably high level of turnover in recent years. Performance has been okay, but not stellar over that period. And we also want to make sure when you appoint a manager, if they have a very clear philosophy or style, that they stick to that. And we have seen evidence of a little bit of style drift over this period. So although we haven't moved it to a negative rating, we think there are other managers that we have kind of more conviction in, and have therefore moved it down to suitable. In terms of some of the other considerations, they apply a kind of multi-manager approach to constructing their portfolios, where different portfolio managers pick stocks, and then these are combined together to produce the total portfolio. And there can be some issues in terms of transparency around individual portfolios of the managers, how they're actually coming together to generate the performance. So again, some questions potentially to ask them as to how they see that working, and if there's any issues. But it has meant that our conviction in the mandate has waned a little bit. So I say it's a suitable rating, it's not negative, but there are other managers that we have more conviction in. A result of the kind of multi-manager portfolio approaches, they also have quite a lot of stocks, 149, which we think is quite a lot, and we prefer managers who have kind of more conviction in some of their active positions. So again, something maybe to ask them when they're presenting about the conviction that they have in the stocks, and if they think that number of stocks is manageable for them to be able to outperform the benchmark. With that, Chair, I'm kind of happy to take any questions on the more detail of the manager performance as you go through the report, but otherwise I was going to stop and open up for questions, if that's okay.
Vanessa.
Simple question. We talk about emerging markets and we talk about Asia Pacific. Where does China sit in there, please? Because I never understand where China sits in all of this lot.
So China, Councillor, so China is currently within the emerging market allocation, but it is an increasingly big proportion of that emerging market allocation. It may at some point separate out, given the kind of growth in that economy, and become a separate allocation. But at the moment, Councillor, it's part of that emerging market grouping.
Steve.
Yeah, thank you, Chair. I've got three questions, quick questions if I could. Firstly, you referred to the CPI level of inflation. I'm not sure whether we will look at CPI or RPI normally, but the CPI index is quite important because that's what they base the pension increases on. So I just wondered if you've got any sort of thoughts as to where that index is going over the year, because that would very greatly impact on our cost side. In terms of oil and gas prices doing well, and you expect the profits therefore to increase. I wasn't sure whether they came under the energy sector, which is going down in terms of returns, or utilities, which is going up. I think that's on about page 28. And finally, could you comment on Majedi being acquired by Lion Trust? Because obviously we put a lot of effort into choosing which managers we do select for to do our investments, and it seems that at the drop of a hat they can be taken over by somebody else who we don't know anything about. Is this something we should be looking at all?
Okay. Firstly, in terms of the CPI, I think it is very, very hard to predict at the moment where inflation is going to go. At the end of last year, I would have possibly said that we were still expecting it to be transitory, that some of the base effects would come out as we go through 2022, and then it would get down to more kind of marginal levels, maybe kind of 3-4% by the end of this year. I think there is a bit more uncertainty around this now, Steve, given some of the political pressures. So it's still one to watch out for. I think in terms of how you're positioned, I think we still expect equities over the long term to stand up well in terms of generating those long-term real returns. Some of the new additions that you've made as well, infrastructure has an inflation linkage to it. So I think there are more kind of upward pressures for it to remain high, but I think the fund is still well positioned in terms of its asset allocation to withstand that over the longer term. I'm trying to remember your third one was on Lion Trust. Sorry, what was your second one again, Steve?
I think it was the energy sector, wasn't it?
Oh, energy.
Yes, so
Yeah. So
in particular, I think we've all seen the announcements from Shell and other groups about absolutely staggering profits.
Yeah, so energy, yes, oil and gas will be within the energy sector in terms of that grouping. So Q4, the overall performance of energy wasn't great. Q1, as I say, was when we expected that to have a little bit more of a bounce, but it's still very hard to predict, I think, in terms of where the oil price goes due to both the supply and demand side of the equation. Given economic growth picking up, Omicron and COVID hopefully starting to have less of an impact, that there could be more pressure on the demand side of the equation. But I suppose that's also one of the uncertainties over inflation as well, whether it's supply or demand driven, and how those could work through in terms of the impact on, say, prices and inflation. On the third point, so yes, it was a good one to raise, and clearly one to ask Majedi about the change of ownership that's planned. I think key thing for us is when a change in ownership happens, that the investment style, the portfolio managers are still able to manage the assets on the same basis in which you appointed them. And so I think there are some ownership changes where we can be quite comfortable that will be the case, but when it has more of a direct impact on the way that the money's being managed, I think that's more of a cause for concern and review, Steve. But at the moment, we understand that it shouldn't have an impact on the way that the portfolios are being managed, but clearly it's one to ask the manager about, although I've already touched on some of the concerns we do have about the ongoing management approach at Majedi, and again, some questions to ask them when they're in the room today.
Chris,
Yes, Joe.
I have asked James and Imran from Majedi to specifically cover the Lion Trust acquisition. I've had a couple of briefings via the access pool with them around the takeover from Majedi to Lion Trust, and they've indicated that it's literally a lift and shift, so nobody is being eliminated, nobody's being changed, as it were. So the style should continue, just with a different name rather than a branding, effectively. But it's a very good question to ask James and Imran if they don't cover it directly.
We'll see. these lift and shifts never seem to work out quite as a lift and shift in my experience, but there we are. So any other questions on item 8 while we have them here? Councillor Braden.
I've just got one idiot question, if I may, just to clarify. Looking at the first page on 8A, I see we've got the climate aware passive fund, 143 million now. That's now outside of the access pool. Was that a decision that we made or a decision that the access pool made? And just to briefly, what was the reason for making that decision coming out of the access pool?
Thank you. We are kind of within the access pool for passive. The structure of the investment pool within access doesn't match the structure for passive investment. So what the access pool funds have done is done a collaborative procurement with UBS to manage the pooled funds. So it's not under pool management, but it's under the pool umbrella, if you see what I mean. So whilst we've disinvested from our direct investments, which are managed by Link within the pool, we are now investing with UBS for passive under the pool umbrella. So under an arrangement that's been made with the pooled funds. The reason for doing that was because as part of our investment strategy from 2019, we looked at the split of our active versus passive management, and we had no passive management at all. So we looked to cash in some of the gains from our active management from global equities and move it into a passive managed fund, which gives almost not guaranteed return, but a guaranteed tracking of the index. And we chose the passive climate aware fund to bring us into a climate aware strategy that would give us a reduction in our carbon footprint to move that way.
So, and the amount was just a percentage of our, how do we come up with the number?
We took advice from our investment consultants, and we reduced our overall allocation to equities from 65% to 50%. And then we rebalanced our split between UK and global to effectively 25% of the 50% UK and 75% global. And then we took the decision to split the global allocation, half active and half passive. So that's where we got to that allocation number.
And I think we've all seen how those have panned out over the last month in particular, that, we look at the COVID recovery figures and we'll see that the UK is very much in the middle of the ranking. I think the North American marketplace in terms of COVID recovery and resilience against it has proved very satisfactory. Not too sure what the UK position will be by the end of the year, but we'll see. Okay, anything else on item 8?
Chair, there was one final bit just to note in terms of funding update. So the performance report focuses on the asset side of the equation, but clearly the other side of your fund is also the liabilities. So just a very brief update in terms of the estimated funding position from your actuary, right up to 15th of February, allowing for some of those recent market movements. So at your valuation date back in March 2019, funding level was 95%. As of 15th of February, it's now projected to be 103%. So benefiting from kind of strong asset returns, but with this more recent volatility I've mentioned, although that means that the assets may have fallen a little bit in value over January and February, the rising bond yields means that your liability value will have fallen a little bit. So still expected to be over 100% funded as at mid-February.
And 103%, what does that mean in terms of a surplus on the fund?
Oh, I don't know. I need to do some quick maths.
It's about 30 million, I think, something along those lines.
Yeah, I was just wondering whether you had the figure to hand up. So.
I've got it to hand, but not right in front of me. I didn't write that number down.
Okay. Whatever the answer is, we'll put it in the minutes. Good. Okay. Thank you very much indeed for that. We'll move on to item 9 now, and we'll get our visitors in, shall we?
It's the one number I don't write down that you asked me about. It's very good. That's very good audit management, that is.
Right.
Oh, the funding surplus is 19 million. 19. 19.
That's lower than I thought.
well, that's as at the 31st of December, when the funding level was 102.6, which is the latest formal report I've got, it's £19 million. So,
So the figure he gave us, we should go on the same day, was the 15th of February, which was 103.
I don't have that information.
Maybe he can get that, just so we got the two for the same date. So welcome to James and Imran. Morning. Thank you. So just to let you know, the session is being recorded. The device is in front of you. If you're not familiar with them, you just press the button to the front on the right. It should turn a red light on. When the red light's on, then your speaker is on. I think there's a limit to 3 at any one time, but we shouldn't hit that limit, I think, very often. I think we'll hand over to you for your presentation, and afterwards I'm sure there'll be quite a number of questions, if that's all right.
Of course. Well, thank you very much, Chairman. Good morning, everybody. Very nice to see you all again. Just as a brief reminder of who we are, I'm joined by my colleague Imran Sattar. He's one of your 4 portfolio managers on the strategy in which you invest with us at Majedi. Once I've finished a brief introduction, Imran will talk to you about the performance, the shape of the portfolio, and the outlook. And Joe Thistlewood has specifically asked us to address the oil and gas and also renewable stocks in your portfolio. So he will talk to that too. And then at the end, we'll have time for questions as well. I'm James Mowat. I'm responsible for the overall relationship with both you here at the Isle of Wight and also with the broader access pool. And I've been looking after you since 2016 at Majedi. Thank you for inviting us along today. This is an interesting meeting for us because it was both Imran and me that were here in February 2020, when there was a very good discussion about the economic outlook and factors that might influence the portfolio. But little did we know there's a big elephant just outside the room that none of us knew was coming down the line. We all know what that was. So that was the last time that Imran and I were out of London. And today is the first time that we've been out of London again since then. So this is quite a sort of totemic meeting or visit to us. I might also just say at a personal level, last time the meeting was chaired by Councillor Axford, and I was extremely sorry to hear the sad news about him, but I will miss him because I thought he was a very nice man, a very good chair. So what we're going to do is, after my introduction, Imran will talk to the portfolio performance, as I've said. There's also a forthcoming change in the corporate structure of Majedi, in that we are due to be acquired by another asset management business called Lion Trust, and so I'll briefly talk to that too. But more broadly, do shout out with questions as we go along, if you would so like to do. I'm very happy to take questions as we go through.
I think we'll keep them to the end if we may.
Okay.
Probably better to do that. Don't interrupt your flow or anything.
Fine, and we will leave plenty of time for questions. Good. All right, well, in terms of the slides that I've circulated, firstly, I thought I'd start with a reminder of the key features of the mandate that you have, that we manage on your behalf through the Access pool. It's called the Access UK Equity Fund, sublabelled as unsurprisingly as Majedi. It's you and one other county council, Northamptonshire County Council, that invest through that, and just over £400 million of assets between the two of you at the end of December. I think the more important point, and since we had that meeting in February 2020, the assets switched into this pool in November 2020. The more important point to reiterate is that you've been good enough to be a client of Majedi since 2009. And the mandate that we run for you today under the Access Pool is exactly the same as the mandate that you appointed us for in 2009. That is to say, primarily UK equities, with up to 20% in overseas global stocks as well. So very much the same mandate. We make reference to our flexible proven investment process, so it's very much the same investment process and the same team. And Imran will give you a brief reminder of the key members of the team that are running your money today as well. So it's approximately 60 to 80 stocks, plus a holding in a small cap fund, which is interesting where some of those renewable names that I talked about earlier feature. And more broadly, Magedia maintains strong working relationships with a range of other local authorities, including other local authority pools as well. So working with clients like you remains an important part of our business and one that we're very proud to have. I'm always cautious about talking too much about us as a firm. We're here to talk about you and your assets, but I'm afraid it is important that we cover off the Lion Trust point, because that is a material change in our organisation, if not in the day-to-day investment process and team, which, as Imran will describe, will remain the same. But nonetheless, there will be a change in the ownership of the organisation. So Lion Trust is a London-listed asset management group, and the reason why we have been acquired by Lion Trust is that a lot of Magedi's long-standing clients have been pension fund clients, many of which are local authorities like you, but many of which are also corporate schemes, commercial schemes. And as you'll be well aware, for a lot of those schemes, they go through a process of de-risking, which means taking money out of equities, which has typically meant some outflows from the mandates that we've been managing for those clients. So for us, the advantage of merging with Lion Trust is that they are much more of a retail-led organisation with positive flows from individuals saving through their self-invested pension plans, SIPs as they're known, and ISAs and lots of other things. So we do believe that the two will be stronger together. Lion Trust will gain from the benefit of Imran and me and others with our working relationship with you and other clients, and we will benefit from the flows and the greater financial stability that they will bring from their side of things. So it should produce a more resilient business overall, which very importantly for you, and you are very much at the forefront of our thoughts in this process, should mean that Imran and the team can continue to run your money in exactly the same way as they have done before. There is, of course, a financial side to the transaction, in that Lion Trust is a listed asset manager, and we are an unlisted asset manager, predominantly owned by staff internally. So we're in the fortunate position that all staff own equity to a greater or lesser degree in Magedia Asset Management, and that will be replaced by Lion Trust equity. So we occasionally do get asked, I'm afraid, if this is sort of a cashing out process, and the answer to that is no, it is not. The equity that we all own will remain within the Lion Trust structure for some years to come at an absolute minimum. So it's therefore designed to ensure that it remains business as usual in all respects. In terms of the performance track record of the assets that we are managing on your behalf, I've set out here the long-term track record of the UK equity strategy that you are invested in. Now, this strategy began life in 2003, and you invested first, Isle of Wight first invested in the strategy in 2009, which is clearly about a 13-year period now. And there's obviously been the switch in structure from your direct arrangement with us through to the pool structure. But you can see the long-term numbers. I mean, the table at the bottom of page 4 contains a range of different performance numbers. Since inception, which did predate your investment, performance at around 2% ahead of the index, so 10.7 versus 8.4 net of all fees. And then over the last 10 years, for example, 8.4 versus 9.7, so plus 0.7 ahead. The 3-year and the 5-year numbers are a little bit weaker, both in absolute terms and in relative terms, so positive absolute returns, but a little bit behind the index. And you can see below that that's really a function from that bottom table of 2017 and 2019 having been slightly weak years when stock markets were very strong and our more cautious approach didn't keep pace with those stock markets. But what you can also see is that since we last spoke to you in calendar year 2020 and calendar year 2021, which are the numbers in the very bottom right hand side of page 4, 2020 was a tough year for markets because of the pandemic, but we managed to offset some of those losses. And last year was a very strong year for markets, and we managed to keep pace with that strong return, which we found gratifying. So a much more strong, positive ability to navigate the very choppy conditions that we've seen in the last 24 months. At that, I'm going to hand over to Imran just to give you a little bit more colour on what has driven certainly the last calendar year, and then and then Imran will talk about the team, the portfolio, and the outlook. Imran.
Thanks, James. Good morning, everyone. I'm going to quite quickly, just to leave plenty of time for questions at the end. So hopefully it won't be feel rushed. But essentially, as James said, it's been a very tough period to kind of navigate markets. It's been very volatile. We clearly had to deal with COVID. Then there was the vaccine news, and there's just been a huge amount of uncertainty. But when I kind of look back, I remember kind of leaving this room and essentially going home and, being locked down and working over Teams and Zoom. The one thing that was really, common across our companies, what we found looking back, is that they've, managed the crisis incredibly well. There'll be kind of one or two exceptions, but in general, the companies that we hold on your behalf have managed the crisis incredibly well, but even more importantly, have come out on the other side stronger businesses. And if I kind of just look at this table on slide 5, Ashtead Electric Components, 2 really good examples of businesses that were taking market share pre-COVID and were winning businesses run by really smart people, handled the crisis fabulously well and have come out even stronger. And, when I talk to Lindsley Ruth, the CEO of Electric Components, and they've got a capital markets day upcoming very shortly, he is incredibly positive about, how he can continue to take market share, a true Darwinian winner. So if there's one thing we're really pleased about, yes, performance has picked up over the last couple of years, we're delighted by that. But what we were even more delighted by is how well the companies have behaved. Now, of course, there are some exceptions. Kinetic, the defence company, it's a fabulous British defence business that has incredible intellectual property. It had a bit of a slip up in the last few months. One contract where they didn't meet the end customer demand. It's one contract out of many, but the shares got punished. Now we think that they've handled the last 4 or 5 years really well. They have executed really well. So we're going to give them the benefit of the doubt for the moment, but clearly keeping a very close eye on that business. The other one I'd call out would be Boohoo, the online clothing retailer. Now, that we've talked about ESG being very important to the process of, our investment process. It's fully integrated into our investment process, but we do think that Boohoo is a business that is on an improving ESG journey, one that's not liked by the market, but we think they've made huge important strides. We spent a lot of time with the company, and we think they're making big strides. That said, the reason why the shares have performed relatively poorly over the last few months is because of its international businesses. Now, you've all heard about the supply chain issues and the freight costs. What that's meant is that if you're a Boohoo customer in the US, and that's quite a big growth driver for Boohoo, it takes about 10 days to ship to a client now versus 2 days pre-COVID. And if you want to, if you're 20 years old and you want a little black dress and you want to go out in a post-COVID world, you're not going to wait 10 days, and that's impacted their growth. But we think that's a short-term dynamic, and the business is on top of it, but clearly been a challenging year for Boohoo. But with those 2 exceptions, I'd say the vast majority of businesses have come out stronger in a post-COVID world, and we're really delighted by the way the company business plans are coming along. I'll skip slide 6 just to remind you, and maybe just touch on slide 8. Just coming back to the Lion Trust transaction, the one thing that is very clear is that we are going to retain our investment independence. As far as you're concerned, as our clients, there is no change to the investment team. There is no change to the fund managers on your fund. And there is no change in the investment process. So this is a simple business decision from Majedi, which we think is best for clients and for us as employees of Majedi. But just wanted to reiterate that there is no change in the investment team that is managing your fund. Just to remind you, James, Chris and I run approximately 30% each of your fund, and John King, our small cap specialist, runs approximately 10% of the fund. So no change there. And then I'll just touch on a question that kind of an issue that Joe wanted to raise, our exposure to fossil fuels and renewables on slide 10. We do have exposure in the form of holding in Shell and Total, and it's very largely in Shell, just under 5% of the portfolio. The first thing I'd say is that we are significantly underweight the oil sector, materially underweight the oil sector, but it's concentrated in Shell, which is a business that we think is the most advanced in transitioning to become cleaner and greener. It's clearly important for shareholders, for stakeholders, for you as clients, that we make this transition in an orderly way. Our view is that the oil majors have a part to play in that transition. It's important that we engage with them and make sure that they're moving as fast as they can. And we think Shell is best placed. We used to have a holding in BP. We did a lot of engagement with BP, and we found that they were significantly behind the curve and not moving fast enough. And we tried to engage with them. We didn't get anywhere. We felt they weren't making enough progress, and we sold the shares. That was a material holding for the fund 18 months ago, but it's no longer a holding. As James alluded to, we do have several holdings concentrated in the small cap part of the portfolio in renewables, businesses that are exposed to the renewable theme. And all of these businesses that you see have the FTSE Green Economy mark stamped on the businesses. I'll just kind of perhaps highlight a couple of them. Volution, is an important business because when you have insulation, I'm of the view that that housing stock in the UK needs to be upgraded such that our carbon emissions from our homes, it's a big carbon emitter. We need to insulate them better. And of course, when you have insulation, you need to have better ventilation, and Volution is a market leader in ventilation. Great business, very profitable, growing very nicely, and a very powerful theme. Genuit is a relatively large holding. Again, it is a business that is right at the center of making sure that we have sustainable water, again, ventilation, great business, again, with great economics, high return on capital, and this lovely growth tailwind that we think is really important. Yes, of course, we totally understand your concerns around, fossil fuel exposure. We're happy to do what you want us to do in terms of fossil fuel exposure. But our view is that the oil majors have a part to play, but it's important that ESG is fully integrated to the investment process. We engage with these businesses very firmly. Where we don't see action, we do something about it, as we did with BP. And then lastly, just to give you a kind of a flavour of the portfolio, we've talked to you consistently over the last 12 years or so about being flexible investors. And we have a flexible investment style, and our view is that it's important for us to be able to make good returns for you over a stock market cycle and over an economic cycle. So we have the great growth businesses like Relics and Fevertree in the portfolio. These are very powerful business models with very long duration growth, very attractive economic moats around them that we think are going to grow for a number of years, key positions in the portfolio. We have some value stocks, and we think Essentra, for example, a component distribution business, the sum of the parts is materially higher than the current market capitalization of the business. And we also have some exposure to a recovering economy, so positions like EasyJet. And of course, again, we've thought about carbon emissions And you know what that means for a holding like EasyJet. EasyJet has one of the most efficient fleets in the marketplace. Now, I know we're all very conscious about our own carbon emissions. You know, I certainly am in terms of how much I fly. But, you know, we do want to experience different cultures. You know, we do need to go on business trips. So we still will be flying. But when we do fly, we want to make sure that we're flying as efficiently as possible. And EasyJet is definitely a way to kind of enable that. So key message for you: delighted by business plan performance from the companies that we own on your behalf. It's been a tough time in terms of navigating the volatility. You know, we think that we own a collection of assets that are very attractive over the long term. And lastly, and again, it's a message that we've repeatedly told you over the last 2 or 3 years, UK equities as an asset class is a really interesting place to be, because there's a big valuation discrepancy between UK shares and global stock markets, and the hunting ground to find really interesting businesses like a Relex or a Fevertree or a Genuit. You know, that the market is really you know, flush with these kind of opportunities, and so we see very attractive opportunity set over the next 2, 3, 4 years in UK equities. I'll pause there for questions.
Right, we'll go around the table, shall we? We'll start with Councillor Andre.
Thank you, Chair, and thank you for your presentation. I understand that you have a multi-manager approach, but obviously there needs to be oversight of that. So my question is, with the new arrangement under the Lion Trust, how will that oversight work, and what stability is there with that moving forward?
It's a really good question, and I'm going to be very frank with you. You know, I've been doing this job for 25 years, and you know, I'm only interested in working for a first-class asset manager, trying to find really interesting investment opportunities, you know, surrounded by smart people, and where we can express our investment beliefs in the companies that we own for clients. If there's anything that's going to hamper that, I'm not around. And the one thing that's really important about the Lion Trust transaction is that we retain independence from an investment perspective. So at the moment, James, as Majedi, James Dupper is our CIO. He provides the overall oversight for the fund. As you said, we do have the 4 different sleeves, and I can do what I want in my sleeve, but James is the CIO. I'm very pleased to report that that's not going to change. So James will remain, I'm not sure he's called CIO going forward, but or team leader or whatever he's called. But you're really correct to kind of call that out, because you know, if that was changing and there was, you know, some other people that might have a lot of influence in terms of what our portfolio looks like, that would be a concern for me. So, but I'm very pleased to report it's not.
But you might have the Lion Trust risk oversight committee.
Oh yes, yeah. So we clearly have a risk oversight committee at the moment at Majedi that will be pushed up to Lion Trust. But from my perspective, that's additive. You know, Lion Trust. You know, I worked at BlackRock for 20 years. You know, they had a very strong risk methodology. You know, when I came at Majedi, very impressed with the way we think about risk. And I've talked. In fact, I had a meeting with Ed Catton, who's the head of risk at Lion Trust. Very smart, very similar thought process in terms of how you approach risk. So on that side of things, you know, if anything, you know, an enhancement, but you know, very, very relaxed.
Carry on, please.
Thank you. I was looking at the balance with the fossil fuel companies. Now, we're in a great changeover situation at the moment where Shell have actually, I think it is Shell, that have opened their first all-electric powering station in Fulham. And I know that Shell are installing a lot of electric points into their stations. So how will this be sort of monitored and managed? Because obviously the balance within the fossil fuel companies over to more sustainable, that's changing as well. So how will that be managed, and how will that actually be reflected? Because obviously the more they change over, the more that fits with our ESG policy.
It's a very important observation, and it's exactly our view, is that we think that these businesses are already making quite important steps to become cleaner and greener, and what they're doing in Fulham is exactly the step in the kind of right direction. Shell had a capital markets day very recently, which we clearly looked through and analysed. They've given some hard data points in terms of becoming net zero by 2050 and being Paris aligned, which I think is really important. They've talked, very specifically about shorter term targets in terms of reducing their carbon intensity by 45% by 2035. So, they've got some, it's not just about getting a target out there, which won't be the current CEO's problems. They've actually set some shorter term targets, which are really important for us, and we've engaged with them on that. So you're right, they are taking the correct steps to become cleaner and greener, and we think they're part of the solution. Unfortunately, we can't just flick a switch and become totally carbon neutral. It's just not practical. Unfortunately, we do have to use fossil fuels in this transition period. Now, one way of doing this is just to divest and say, we're just going to sell all of our shares and, it's someone else's problem. Now, I think that would be a mistake. I think it would be a mistake because if there is a chance that all the, that Shell goes into the hands of shareholders who don't care about the transition, and therefore Shell actually might move at a much slower pace in that energy transition. So it depends kind of what we kind of really want. Our view is that it's part of the solution, but it's important that we engage with them. And as I said, BP, try to engage a lot with them, and very clear, not moving fast enough. And therefore we had to divest, because from an investment perspective, it's a riskier investment because they're not making the transition. We all know they need to make that transition. So, on balance, I think it's right to hold Shell, given the progress it's already making in becoming a sensible, diversified energy business. It's not going to invest any more into fossil fuels from 2025 onwards. Clearly, it's had projects sanctioned which it has to complete, but from 2025 onwards, in the capital markets, it was very clear, no new fossil fuel investments. All of the capex is essentially going to go in becoming cleaner and greener. But if you told us and said you want us to divest, it's something that we can clearly do for you. But on balance, we think the current approach is the right approach.
I agree, and I think it's all about the relationship. I think it's important that it's monitored, but that we maintain those relationships, because, as you say, the move has already started. So thank you.
Thank you, Chair. Yeah, my question is just following on from Debbie's, really. It was about the Shell thing as well. Could we see some proof of that, because of the pressure we're under and the questions we're getting from public all the time, to actually prove where we've got our money, and that they want to know how much we've got invested in these. So it would be nice to see that progress that they're making, to see what Shell have already done and where they're going forward, so that we can actually see that as well. And then, like you say, we've got that relationship with them, and we can come to you and say, well, we don't think they're actually, are they still, or, and actually talk about whether they are still fitting the needs of what we've got to sort of prove for our investments.
Yeah, no, again, a very good point. But I just, if you wanted to have a look, and it's on Shell's website, if you just type in Shell Investor Relations, and we can obviously supply you with a kind of summary of it, but it's the presentation that was. I'll give you the date of it.
We
can send it around.
We'll follow up with exactly that point and the sort of data points that we're looking at for reassurance that progress is being made, and you can have a look at that and see whether you agree with us or not. But we'll send it through and we can have that conversation.
It's actually a really interesting presentation, and it's the one that's dated May the 7th of 2021. In particular, slide 5. We're going to a lovely summary in terms of the hard targets that they've set out.
We'll look forward, I think, for that to come in right now. I think Joe wanted to come in briefly.
Just very quickly to say the Majedi website does have copies of their stewardship reporting, so their responsible capitalism report. Sorry, wrong glasses. I can't work out which ones I need to see. So I will send the link round to the historic responsible capitalism reports, which set out their ESG and engagement activities. The most recent one is the 2020 version, but as soon as the 2021 version is out, I'll make sure that that gets circulated around as well.
Sorry, just go around in a circle. Councillor Braden, anything to add, please?
Oh, sorry.
Thank you, Chairman. My question is around Lions Trust. I'm always very wary when two companies join together or one's acquired by the other. Having worked in a bank where one apparently acquired the other, there was a lot of internal aggro for years about merging policies and thought processes. So I'm very nervous about takeovers. I know it's described as like a drag and drop exercise, no change to fund managers, but I really do question over time how people are going to really pull these two companies together without some change, which makes me nervous. So my questions really are, who approached who? How long have Lions Trust been going? And what guarantees are there for you, and more importantly for us, about our investment? Because I'm nervous about it.
Sure. Okay, thank you for the question. So to take your point, to take your specific questions, we approached Lion Trust. We as a firm thought that this would be the right strategic direction for Majedi as a business and the right thing to do in order to produce, in order to underpin the returns that we were seeking to produce for clients. So we approached them. Lion Trust floated on the London stock market in, I think, 1999. So it's been around a long time, older than Majedi, in fact. And they've grown through a combination of organic growth and some acquisitions of the sort of drag and drop, I think was the phrase that you used, which I think is a nice way of putting it. So they tend to be sort of businesses where the Lion Trust model has been to take a series of teams with a distinct identity and process and keep them as those investment teams. And they've done that in a number of different ways. So they can't have 6 different investment teams. There's a combination of organic and acquired growth. And each team has its own identity and is left to its own devices. And so in terms of, therefore, to your third question about the reassurance that we've been given, clearly nothing is, we all know there are no guarantees in this world, and you're absolutely right, I think, to express a degree of skepticism, and we ourselves have all had those thoughts and gone through that process as we've announced this transaction. Where we gain reassurance to your question is that firstly, we've seen how they've acquired these other fund management operations in the past, and they have left them in their own devices, aside from things like the risk oversight point to the earlier question. And secondly, at a more practical level, they have, so for example, we will stay in our own office, which is on the old, next door to the Old Bailey courthouse in central London. We won't be shoved off into another office. We won't blend together with other teams, and we'll just be left at our own desks in our own devices. To the investment team's own devices. But you are right in terms of when teams join together, there will be change, particularly on the operational side of things. So the brutal truth is that there is overlap in things like legal, compliance, accounting. And while we expect the vast majority of Majedi staff to retain jobs, I think there may at margin be 1 or 2 people who I hope will sort of naturally decide probably to retire and things like that. And so there will be some changes. But we're going through that process now of those operational changes in terms of systems. The good news is that we use a lot of common systems, whether it be the investment team systems or those operational systems, and that process is all going very smoothly. So I entirely accept the question. You're right to express a degree of skepticism, and you have our assurance that it's going as we expected at this stage. we see no reason why there should be any material changes post-transaction, but we will, of course, keep you posted.
But my follow-up question then is, it's good to hear that there's really no change, no new offices, and really no changes to message. Sorry, that's all right. Okay, there's too many on, sorry. That's my follow-up question, if I may, then, is because it's good to hear that there's going to be no change to our investment, it's going to be fine, and no change to offices, no change. So what's the point?
Yeah, but the point is that the investment industry has changed in the last 5 to 10 years, and the business that we have historically successfully undertaken has changed and shrunk. And the pool of what one might call institutional assets, and I would include something like the Access relationship under that institutional heading, that is smaller than it used to be. And that is a reflection of the way in which employees now save for their future retirements. They don't do it through corporate schemes so much anymore. They do it much more through their own schemes. And those require different distribution channels. And Lion Trust is one of the leading players in that respect.
Yes, I'm looking at your chart on page, where are we? The embedded ESG approach. We talk about series, I'm not sure how you pronounce that word, in hydrogen, only 0.04. As a personal opinion, I think hydrogen will be the way forward. I'm not convinced about electricity because of getting the batteries and everything else that goes with it. And we talk about fossil fuel companies. Now, BP are building, I think, with a few billion, a hydrogen plant up in the northwest. So I would like to know if, how, why, and when we are not investing in that, because I see that as a future. The thought of building a nuclear power plant, quite frankly, sends me into orbit. We talk about being green. I can't see anything green about a nuclear power plant, however, but I am interested in the hydrogen and possible investment.
I agree with you. Hydrogen, I think, is a fascinating area, and it could be the solution. The slight problem is that making it work in an efficient, profitable way is quite challenging. And actually, if you look at all these names on that page you just referenced on slide 10, Ceres, the hydrogen company, is the only one that's not profitable. We're inclined to back companies that are absolutely at the forefront of making that energy transition, which we all know we need to deliver on, but we have to do it in a way that's return accretive and meets your liability requirements. You know, we can't just do it in a way where it's endless losses, endless risks, where you're backing businesses that might not be around in 3 to 5 years. And the transition has to happen in a return efficient way. And the problem with hydrogen at the moment is that the economics are still quite challenging. Now, hopefully with technology, that can change. And I think Ceres is at the forefront of that, but it's yet to be determined. But what's really interesting is that that's the only one in this list of names that's not profitable. But hydrogen could be the future. We're just not sure at this stage.
Thank you, Chair. It's it's only perhaps I'm looking at it too simply. You've got Shell down under fossil fuels, but then you're actually saying that they diversify away from fossil fuels. Is there any way we can actually have that broken down within their? Yeah, you just said was 4.2 fossil fuels. Well, it's not, from what you're saying. That's not is a total figure.
It's exactly right. It's the wrong classification to just think about Shell as a fossil fuel business, because you're right, it is making quite important strides in becoming more and more renewable energy led. The problem is, how do you cut it? Because at the moment, the returns on renewable investments are much lower than those on the fossil fuel investments. So if you cut it by profit or cash flow, you know, it's a very small part of Shell. If you look at the capital investment, the amount of money Shell is putting into renewables, then it'll be a larger pie. I think that's something we can perhaps do in 2 or 3 years' time when we've got more data from Shell. And there's another good example. You know, we've always said ESG is fully integrated. We're asking Shell for more and more data. Now, as they deliver on the transition strategy and as we get more data, we will update you and give you a sense of how you can apportion Shell, you know, old world fossil fuel, new world renewable. But you know, at the moment, the data is not good enough.
Steve.
Okay, yeah. Thank you, Chair. Steve Milford from Unison. I think it gives some very useful ideas in terms of developing our own ESG policy if we wanted to be a bit more proactive. And I think I was right in saying that if we said to you, can you proactively invest in these green companies or divest from these companies, which we are more suspect about, you could do that for us. And by ways of example, in terms of proactive investments in positive green companies, you would say put money into things like Volition. If we were to do sort of neutral investments, things like Shell, because they're fossil fuels, but they're investing in the green sector as well. And if we wanted to proactively divest, it would be companies like BP, if I kind of capture that right.
Yeah, that's broadly right. You know, at the moment, we're not restricted from investing in fossil fuel investments. As it happens, like, you know, your concerns, we share those concerns, and we don't think BP is moving fast enough. So I think at the moment we have plenty of latitude to express our investment views alongside our desire for companies to make that energy transition. Because I think, you know, the last thing we want to own, even if you say go ahead and invest as much as you want in fossil fuels, we think that the risks are that you end up with stranded assets in 3, 4, 5 years' time. And if these businesses aren't making the transition, then I think there's a risk that these are significantly less valuable investments in a few years' time. Forget about the need to make that transition. But at the moment, we have enough latitude. If you want us to go further, then, you know, we can look at excluding fossil fuel investments. But as I said, our view is, on balance, that's probably not the right thing to do. But you're the client, you've got to tell us what you'd like us to do. We can do use the approach we're doing now, or do something a bit more aggressive. But just to say, obviously, if you did exclude fossil fuel investments, we won't be able to invest in Shell, which we think actually is helping solve the problem.
Any other questions? Otherwise, I'll put my own. Good, my turn. So within your portfolio, you have a very diversified portfolio. I think that poses some concerns in terms of the management drain that must represent, and the inference that it provides in terms of focus and direction and ability to concentrate and to become much more intimately familiar with the companies that you choose in a more limited portfolio. I wonder if you could reflect on that.
Yeah, it's a good question. I'd say looking at the overall number of stocks is slightly misleading, because there's the individual sleeves, the 3 large cap sleeves, are highly concentrated. There are approximately 35 to 40 stocks each. And then clearly there will be some overlap between the 3 large cap sleeves, but the individual sleeves themselves are highly concentrated. Where you get a longer list of stocks is in the small cap area. That's the key determinant of the large number of stocks in the overall portfolio. Now, there's very good reason why you need a longer list in small cap, because of liquidity. The opportunity set is just larger, and John and Ed are doing a really good job in handling the number of companies that they manage. And if you compared the number of stocks they own in their small cap sleeve versus other small cap funds, it'd actually be quite concentrated. So you're right to highlight that at the overall level, there is a large, there's a long list of stocks. But actually, because at the individual sleeve level, it's absolutely manageable, we have no concerns. And this is a kind of tried and tested method for the last 20 years. Right. It's absolutely deliberate, but it's a very, very good point.
So the second question is the performance relative to the benchmark was 0.6 down for the quarter.
Yes. Yeah, so having had a very good 9 months through to September 21, the last quarter, yes, was behind the index. So still ahead for the year, net of fees, but the 3 months, you're right, were a little bit behind. And it was, the two stocks that I highlighted, the performance, Boohoo and Kinetic, essentially all came in the fourth quarter. Aside from that, the performance we were delighted by, and as I said, the first 9 months were very strong.
So you think those two exceptional events wouldn't be repeated going forwards necessarily?
Well, of course, never say never, but the Boohoo, I think, we understand why the shares have done what they've done. It's been, some of the supply chain pressures, the example I gave in the US. You just can't have 10-day lead times. That's been a problem for them. Been largely out of their control, but that's a fact. And then Kinetic, if it wasn't for the excellent execution of the business over the last 5 years, we'd be very concerned about this one contract. But we've engaged with the company. We've met Steve Wadey, the CEO, 3 times in the last 6 months or so, and we feel comfortable that they're on top of it. But as you can imagine, keeping a very close eye on it.
And then the third one is just one to throw open to the committee itself, is regarding your mention of us being able to proactively divest in a particular sector. If I turn to page 18, and for my colleagues, the 18 is the blue number in the bottom left-hand corner of the page in about 1 point, which is why I had to reach for my glasses at this, which is the page that talks to the UK Equity Fund portfolio positioning. If I can show you the page, it might assist. 18. Yeah. So in terms of suggestions for proactively divesting, one of the names that I noticed on the right-hand side was the tobacco industry, which the fund is apparently invested in. Is that still correct?
No, we do not have any investments in tobacco.
Okay, so that's been completely...
So to explain, the reason why you're seeing tobacco there is it's showing it as a negative position, and these positioning, if just to explain, if from the top it says key, the title of that bar chart is key sector positioning brackets relative. So the relative bit is referring to the positioning relative to the FTSE index, the FTSE All-Share Index. So the FTSE All-Share Index has 3.1%, primarily and entirely represented by British American Tobacco and Imperial Tobacco. Imran and his colleagues do not hold either of those stocks, and so by having nothing in those two stocks, the relative position is minus 3.1. So what they're saying is there's no exposure to tobacco.
I'm sure we'd all be happy to maintain that zero investment in that particular sector. Right, thank you very much indeed. Are there any other questions? Councillor Richardson.
Is that working now? Yeah. Okay. So it's about the other places we've got investments in as well, and looking at where they invest as well. And are we looking at their ESG and investment? So you said you've got some in NatWest Group and some, so just different ones. Are you working with them to look at their investments too, really? Because obviously, you've got the direct one with Shell, but what about the indirect investments?
Yeah, it's a really good question. So, when we talk about Shell's reduction in carbon footprint by 45% by 2035, that is using scopes 1, 2, and 3. So that's their own operations, but also the supply chain. So it's a really good question, and we do look at all of our companies, and not just the fossil fuel businesses and what they're doing in terms of making themselves carbon efficient. And Fever Tree, as you know, it's a large position for the fund. It's a brilliant brand. I hope lots of you use that as a mixer. But their product in the UK will be carbon neutral by the end of this year, and it will be the first mixer business in the world to do that. And we've been pushing and engaging with a company to do that. So there's a good example of a company in its own operations becoming carbon neutral. And of course, if you think even more holistically, Aveva is a software business that is in its own operations, very carbon efficient, but its software allows other industrial plants to become more and more efficient and reduce their carbon footprint. So actually there's a fabulous example of thinking about ESG holistically, and owning a brilliant business with great returns and great margins, but a business that's also helping reduce costs, reduce carbon for many industrial businesses around the world, including oil and gas companies.
Another question with that. So if we identified some that were still investing themselves in fossil fuels, that we could say, actually, we want you to not invest with them or put forward.
Yeah, it will be very, very hard for you to tell us that, exclude any company that has any exposure to fossil fuels in their own operations, because in that way, you'll probably exclude 90% of the FTSE All-Share universe, and then you'd be left with a slither of companies to invest in. Many of them might, not be good investments. So the question is how far do you kind of want to go down the line? Now, my approach has always been, have some restrictions, but then, with having ESG integrated into your investment process and through engagement, make sure that the companies that we're investing in on your behalf are doing the right thing to reduce their own carbon emissions. And, in the Fevertree meeting, they spent 15 minutes out of in the hour talking about their carbon reduction plans. With the PZ Cussons meeting at an FMCG company, I just had a meeting with the CEO recently. We spent at least 10 minutes talking about their carbon reduction plan. So this is really important for us. I know it's really important for you. Through engagement, I think it's the best way to make sure that we get carbon, achieve carbon neutral and Paris alignment.
So yeah, that's really what I wanted to ensure, that we have got that engagement with them, that if we identify some that we think they're not quite doing what we think is most socially responsible, but we can come to you and say, can you engage with these companies and see if there is pressure that can be made to improve it if possible. Thank you.
Just very briefly to add to that, I think the government and a lot of companies now are actually putting timelines on these things. And you've already mentioned, for example, with BP, that you didn't feel they were moving quickly enough. I do appreciate that in an ideal world, we would say we want to take that position now that we don't invest in anybody that is using fossil fuels, but that is unrealistic. But as you've already said, you've identified where companies aren't moving quickly enough. So I think that's an important part of our strategy, is that there is a timeline on it. So we don't say we don't want to invest in you, but we don't think you are doing enough. But I think timelines are important, so that might be something to consider.
Thank you for inviting us along. I do hope that we've helped today. If you have any follow-up questions, do of course feel free to come back to us either directly or through Joe, however you wish to do it. We're always happy to take questions, and more to the point, you raised some very interesting points about ESG today and hydrogen and lots of other things, so we will keep you appraised of that as we go along.
All right. Thank you very much.
Very good to see you all. Thank you.
Thank you. Yes, thank you. Yeah. Thank you.
Thank you.
It's really useful. Thank you.
Shall I suggest we just pause for a few minutes in case anybody wants to go and take a comfort break, and we can just suspend the recording a minute and let anybody who wants to go and do that.
Put the fan on.
Did we pause the recording?
Yeah, we can't fully pause the recording, but I can turn the camera off. and.
Does it turn the sound off as well?
Yeah, turn the sound off, so
Yeah.
it'll still be playing, but there'll be no muzzle.
Yeah, I should have got them to bring it in.
I've just been called by somebody who's then brought the baggage outside. These two gentlemen.
Oh, there's a potential bomb threat. Yeah. Okay. Yeah.
Thank you. This is the start of the Joe show, so just be prepared for that one. I don't propose really to give too much of an update other than what's already been presented in the papers. We have had one nomination for the external employer representative, but due to budget pressures, I mean, as in pressures of working and finalising the budget, that information hasn't yet been shared with the Director of Finance, so I will send that through to him shortly. And in terms of the independent chair position, we have a second candidate discussion this afternoon to decide on the appointment, with hopefully making a decision tomorrow for the independent chair. We are still on track for the next board meeting to happen on the 23rd of March. And the agenda will include a review of the consideration of the terms of reference for the board, so that the new board members can agree to what they're signing up for. So unless there are any other questions, members are asked to simply note the process being followed for the recruitment, selection and appointment of board members.
Sorry. Could I just ask one question, and in fact it relates to all the papers that we get? I fully appreciate that Joe's reporting on the basis of how the financial impact will impact on the council finances, but obviously there are costs and estimates to everything we do, albeit that it does go to the pension fund. Could we see the actual kind of figures or estimates in the reports of what the costs will be for all proposals in future, even if they are, say, estimates, and fully accepting that it will go as cost to the pension fund? But I think for transparency, we just ought to see the figures.
One of the key actions that is on my list, that I think has been on the list for about 3 or 4 years, is to actually finalise and formalise a pension fund budget. We do monitor the costs and we do report them to you on an annual basis as part of the financial statements, but we don't have a formalised budget. So it is on the list of things to do, and hopefully with the resources, the changing structure and resources that we're working through at the moment, we will get that to a formal note. But yeah, thank you. I do take that point, and I will make sure that I do that in future. Apologies. Okay. There's a working group update. The update from the working group is that the working group hasn't met since the last time we had the committee meeting. However, there has been a lot of activity being undertaken in a sort of informal basis, which I've outlined in the report that's presented at agenda item 5. The LAPFF, the Local Authority Pension Fund Forum, Claire and I attended our first business meeting, which was very interesting, very informative, lots and lots of information, which at the moment is all in private session. But because the fund is a member of LAPFF, all elected members and officers that are interested can have access to that website. So if you are interested, I can get you to sign up to it. We will share information as it becomes public. One of the things I do need to work on, one of the other things that I need to work on, is how we report back responsible investment activity in terms of engagement with LAP and with the fund managers, etc., to this committee or to the working group, and then for the working group to report through. Again, that is on the list of things to do, but given at the moment that I am one person and Joe is 0.6 of a person on the pension fund, we don't have the capacity to do that at the moment. We are very much working, it'll be 0.2 from 1st of April. So we are very much working on that, but we're not quite sure how we do it. So we're trying to get that through. There's lots of activity been going on nationally in terms of the response of the Scheme Advisory Board. and consultations and impact investing, where we've had various discussions with pensions for purpose and some other areas with Councillor Quigley. It's just another one of those things that there is a lot going on, and it's very difficult to fit it all in, which is why we suggested we had the ESGRI working group. The key issue at the moment is there is so much going on, we haven't had time to have an ESGRI working group. So that's on the plan to do. Again, a lot of activity. It's a really important thing that we need to do. Membership of LAPFF is just over £10,000 a year. So that will be included in the budget going forward. But I'm happy to take any questions otherwise for members to note where we are and support us in trying to make it better going forward. This again is one of the quandaries of current legislation and regulations in terms of pension fund governance. The Pension Fund Committee that makes all the decisions has no statutory or regulatory requirement to have any level of knowledge and understanding to make those decisions, whereas the pension board members, who are responsible for ensuring appropriate standards of governance and administration but don't make any decisions, have a legislative requirement to have a minimum level of knowledge and understanding. So what we're trying to do is run development sessions that are relevant to both committee and board, and everybody's invited to attend them. I would say thank you very much. For the first time in 2 development sessions, we've had 100% attendance at both. So thank you so much for coming. It makes my time worthwhile. The report that you've got in your pack summarises the sessions that I've publicised to you and hoped to identify those people that have attended them. Please, can you let me know if you are attending them, because we do need to report at the end of each year on what knowledge and understanding activities have undertaken. I have also circulated to you the Pension Regulators Electronic Toolkit that has 7 modules. It would be ideal if you could complete that. So far, I've had confirmation from one of the committee members that they've completed all modules and not had any response from any of the others. So please, could you do it? It would be really helpful. And the big gap in our compliance with the good governance requirements is the fact that we don't have a formalised training policy or training plan. So again, that's on my list of things to do to build into the work plan going forward, so that we can actually put a training plan together, so that we can ensure that you as committee members and the board as board members have the right level of understanding of all of the documents and policies that we're undertaking. Happy to take any questions.
I'll just make a comment. Obviously, I have done the training and that Joe was talking about, and I was just going to encourage you all to perhaps have a look at those modules, that they weren't as bad as they look. So, and they were quicker than I thought. So, please do have a go at them, and maybe do one at a time every now and again, quickly. Just so.
How long did it take?
Well, I think they recommend that they were 20 minutes or something, and they weren't any longer than they said each little module. I think it was about 6 modules or something to get through. So,
Good morning.
yeah, but I did them over time.
Yeah.
You know, so actually, but
Okay.
they weren't as bad as I thought, because they do a little test at the end, and you think, but I passed each one like first time, I think. So you know, it can't be that bad.
Without cheating. Very good. Thank you. So number 7, the legislative and regulatory update.
Again, sorry, there's no paper, just ran out of time to write that one. The biggest development recently is the Levelling Up white paper that you will have seen. There are 3 references to the LGPS in that, and they all say the same thing on 3 different pages. Effectively, government are setting an ambition for LGPS funds to invest up to 5% in local projects. Now, local means the UK.
Yeah.
It doesn't mean PO30 or PO44 or whatever it ranges. So local is the UK. 5%, it says up to 5%, but 5% isn't a ceiling. it can be more, and it has to be new investments. So we can't say we've already got a 5% allocation to invest to infrastructure. And it is mandatory to have a plan to do it rather than to actually do it at the moment. But there needs to be a plan that says we will do it. And the projects could be local businesses, housing or infrastructure, but in the UK, not necessarily on the Isle of Wight. There will be a consultation on the levelling up paper, I believe, in the summer, and that consultation will also cover climate change and climate change reporting, pooling guidance, and potentially something else that I wrote down, but I can't remember what it was. So there's a big consultation, a mammoth consultation on lots of disparate issues coming out in the summer for the LGPS regulations. Might also include the pensions of public pensions and judicial officers bill for the McLeod remedy in terms of age discrimination. We've got the pensions dashboard that's coming up where everybody's pension information will be in one place. The staging date for the LGPS on that is October 23, but must be live by April 24. So there's a lot of work coming up on that. The exit payment cap, where they're looking at reducing or limiting the amount that can be paid for people leaving public sector, is likely to come back. It came in, it went, and it is coming back again, but there's going to be individual rules for each scheme rather than a blanket scheme that is currently or ended up being contradictory to the scheme regulations. The cost management exercise for the 2016 valuation is almost complete, just in time to start the 22. There's a judicial review being called by unions in terms of some of the elements that were included in there, but the outcome of the judicial review could result in some changes to the scheme in terms of benefits and contributions, but that's still out there at the moment. And lastly, for those of you that know him, Jeff Houston from the Local Government Association is retiring after 11 years at the LGA. Jeff Houston. He's retiring from his role at the LGA, but he'll still be involved in the LGPS in some instance, and his role is being taken over by Joanne Donnelly from the 1st of April. So it's all changed at the LGA, all changed under the LGPS, but we don't know quite what's going to happen until the consultation comes out. But lots of changes and lots of updates. Happy to take any questions.
Is the judicial review still related to is that the one still related to sex, age and dependencies calculations?
I can't remember. What did Jeff say? It's to do with McLeod, yes, so it is to do with that.
Yeah. It's a very long unresolved issue. Councillor Andre.
Yes, thank you for that update, Joe. Can I just clarify the consultation? What will be the consultee of that?
So who will be
consulted?
Consulted. It will be a national consultation. So I was going to say MHCLG, but I don't mean them. I mean
the levelling up one.
The levelling up people will be consulting, we're issuing draft regulations for changes to the statutory, and it will come out to the LGPS, to committees, to boards, to
so all
advisors.
The LGPSs.
Yes, I believe so.
And my other point was that I see this as a massive opportunity. And I know when you said local, it refers to the UK, but I think it's incumbent upon all of us to try and identify projects on the island, if possible, that we could actually invest into, because that's our strategy going forward, is to actually bring back investment onto the island and actually boost the island economy. And if we can do that through our own pension fund, how fantastic would that be?
And 5% of 750 million is quite a lot of money. Councillor Churchman.
Yes. The 5%, Joe, of course, this was something that Osborne wanted to do when he set up. Pools were set up because Osborne thought he could then make them invest in this country, because as a country we invest more abroad than anybody else. However, the 5%, Joe, will what we put into Access be counted as that 5%, or are they talking about each individual pension fund?
I don't know the answer to that, Vanessa, at the moment. I think the intention is the LGPS has multi-billions of assets collectively. 5%, I think, is about 16 billion nationally. So the intention is that 16 billion pounds is targeted from LGPS to be invested in the UK. It's not necessarily that we would have to do it individually. It could be that there is a pooled solution. So Access together could create a fund with 5% of all of the collective assets in to be invested locally. Or it could be that there's a national solution that we all cross-pool activity to an extent. But the key point is each local authority has to have a plan to do something. It could be that we target some of that to Isle of Wight activity. But the key point to remember is we are a small fund. We do not have the capacity to necessarily do stuff ourselves. We don't have the knowledge to do local investments directly. Councillor Quigley has been quite active working with Pensions for Purpose on looking at place-based investment, and is also looking at the community wealth building activities for the island as well. So it's something that we could dip into, but what we do have to remember is that we are investing this money to get a return to pay the pension benefits. And whilst it may be very attractive to say we're investing on the island, we can't compromise the returns and the future investment benefits that we need to be paying. So
if I can just come back in, yes, I mean, obviously we do appreciate the principle here that we are actually acting for the pension fund. Perhaps that's an item that we can make sure is on the Access agenda for our meeting on the 7th of March. I'm sure it probably will be.
I think it's not directly going to be on the agenda this time, but as part of the work that is being done with Access in terms of looking at its illiquid solutions, which we're covering later on in the agenda, part of that will be covering property infrastructure. So it's something that we could be looking at as part of the pool. So I will continue.
But more specifically, under this levelling up.
This is a new agenda item, so it's something that we can build into future discussions. Absolutely.
Thank you.
My reading of the document, because I read it as well, the 3 times you say it was reflected, was that it's the fund, the pension fund, which must do the 5%. It didn't say an amalgam of pension funds, or it was very much a pension fund. So we are the pension fund. So I'm presuming the interpretation would be that we must reach the target, not. And if we do that partly through our directive and partly through Access, that would reach it. But we can't say we'll do nothing and some other fund will do 10%, for example. We have to meet it ourselves. So I think Steve had something.
Sort of quickly comment on the whole principle of levelling up. If the government's serious about levelling up between poorer and richer communities in the country, they might say, well, you can invest anywhere in the UK. I mean, they really mean in the sort of underdeveloped, if you like, areas of the country. Because if we were to sort of choose a particularly prosperous place to invest in and say, well, we've put our 5% into there, that is really going with what the levelling up principle is about. So I would have thought that we could be obviously more selective and possibly local.
I think it'll be something for the future, and we'll wait and see how the clarity comes out. But on the levelling up, yes, out of the 54,000 million, we did get one of them, so that was quite nice.
Chair, is it okay if I make a couple of comments?
Yeah.
Just that the first one, Joe, and I think in terms of the 4th area that we're expecting this mammoth consultation might cover, I think it might be the CMA requirements to put that into legislation. So at the moment, if you remember, you're required to set objectives for your investment consultant and assess me against how well I have met those objectives. So I think the 4th area is to cover that. The other thing is just to note there is a Scheme Advisory Board Investment Engagement and Governance Subcommittee scheduled for Monday next week, which I'll be attending, but that has an initial paper on the Levelling Up White Paper and a recommendation for the Scheme Advisory Board to prepare an initial response to that as well. So that was all I just wanted to know. And there's also an item on the Michael Link letter about the kind of exclusions on Palestinian or Israeli related investments, and looking to clarify the position on that.
Right, thank you. So we now jump on to item 10 on our agenda, back on track. Quite a number of items to note. I'm not going to go through them individually. I'll just see if anybody wants to raise any questions on any of the copious amounts of information that Joe has been very, very good at distributing. No? Well, we'll
Just
sorry,
that
Sharon.
I will be going to the Say on Climate event, and I keep trying to attend as many things as possible. So
Yes.
thank you, Joe, for sending them around. It's really useful that you keep reminding us. So thank you.
Good. All right. Item 11 on the agenda, members' question time. Are there any questions from members? Do we have any written questions? No written questions? Any questions while we're here? No? Thank you. Next one is I need to read out, which is to consider passing a resolution that under section 100A4 of the Local Government Act 1972, the public and press be excluded from the meeting for the following items of business, namely agenda items 13 to 17 on the grounds that there is likely to be a disclosure of exempt information as defined in paragraph 3 of part 1 of schedule 12A of the Act, and in all the circumstances of the case, the public interest in maintaining the exemption outweighs the public interest in disclosing the information. Do I have somebody to propose such a motion? Councillor Oliver and Councillor Braden's supporting it. Thank you. Everybody in favour? So carried. Thank you. Now we go into silent mode, do we?
Is David staying?
David's saying the first part, because it's his report.
Yeah, it is. Yeah. A bit tough otherwise. Yeah. So we're now going to jump on to page 45 of your document, where we go into the grey zone. Yeah, I'm just waiting. We're still showing recorded. Are we off now?